first batch of data we had was like 45 cases, and the numbers were so good. I couldn't believe it.
Hello there, my friends. Chris Marcus here with you for Arcadia Economics, and today excited to have my friend Louis James Lobo Tigre of the Independent Speculator back on the show. A lot of you already know of Louis. Been fortunate to have him on the show a couple of times. Does some great research and was excited because there's a concept that he really did the research on and made more widely known that I think is really relevant, especially with all the things going on in the mining world today. So Louis is kind enough to join us. Before we get started, hit that subscribe button. Go ahead and hit the notification bell too, so that way next time he's on the show, you'll know as soon as it happens. And with that said, Louis, great to have you here today. How are you doing, my friend?
All righty, Chris. It's a sunny day here in paradise in Puerto Rico, and enjoying the tax benefits much more than the earthquakes and hurricanes. But it's good to be alive right now.
Yeah, well, I'm glad you're down there and safe and in one piece because you do some great research. A lot of stuff that other people don't notice or don't see. And along those lines is the pre-production sweet spot, which I've heard several mining analysts reference, which you really were the one to do the research and dig into that. So I think it's relevant for folks who are investing in the metals, and perhaps you could break it down what that actually means.
Sure. Well, this is very timely. As you and I speak, I don't know when you'll post this, but as you and I speak, gold just spiked over 1,600, so there's going to be a lot of interest out there. And the pre-production sweet spot brings speculators an opportunity to do something really extraordinary, which is a combination of minimize risk and maximize gains. And I'll explain that in just a moment. But first, I want to back up a little bit and say, I did not discover the pre-production sweet spot. That word, or that 4 words, the phrase, was long existing when I came into the business. My mentors, Doug Casey, Rick Rule, other people that I learned from, they mentioned the pre-production sweet spot. It's what it was called and had been for a long time. And specifically, what does that mean? It means the transition, pre-production, from building a mine to producing from that mine, from spending money to making money. So it's obvious that if you're successful at doing that, that you should get a re-rate, from spending money to making money. It's pretty obvious. And because it's obvious, it was always assumed that, yeah, there would be a re-rate, but it wouldn't be very big. It would be priced in advance. People would see it coming. It's no secret who's building a mine. So maybe there's some reliable gain there, but it would be small and not the 10 baggers that we're looking for in this business as speculators. So that's the context, and that's really my contribution, my claim to fame, as it were, as a resource sector analyst, is that to my knowledge, I'm the first one to actually measure this, to collect the data and measure it and put out numbers on what is the gain in the pre-production sweet spot. And the funny part of this story is that when I first started working on this, it was in 2016, I had the idea and we started collecting data. And the first batch of data we had was like 45 cases, and the numbers were so good. I couldn't believe it. I went back to the boys and I said, guys, I can't believe this. Go back, find me more cases. It was only like 40 cases at the time or something. I said, there have to be some big wins here skewing the data. This can't be right. So we go back and we double the sample size. And yes, the numbers came down a little bit, but not much. They were still pretty close. And we did it a third time. And by that time, it was harder to find new cases. Going all the way back to the 80s, we really scoured the research out there. The publications, old editions of the Northern Miner, everything we could get our hands on to find more cases. And the numbers came back, not to create the suspense too long, the numbers came back, and the average gain from a construction decision to first pour, when you start producing, was on the order of a double, just over 100%. And that typically took a little bit less than 2 years. So it's not a double overnight. It's not a vertical hockey stick, but it is a swoop up to that first pour moment where you can fairly reliably make a big win, the average of which was about 100%. That's what we published. When I had the data, I went to Doug, who I worked for at the time, Doug Casey, And I asked him, so what do you think it is? He says, oh, I don't know, maybe 20%. Nope. 50%. No. And he was gobsmacked. He was shocked by the actual numbers that we found. And everybody I had this conversation with, Bill Bonner, Rick Rule, other people, they were shocked by this. So we published, and since then we've updated it. I've moved on from Casey Research. I had to redo the research since I deleted all my Casey files. It was their property. I redid the research on my own and have expanded the database. And we consistently are finding similar results. I do have some new results I want to talk about, but this is the idea. The idea is that most people who start to build a mine actually succeed at doing that. A bank wouldn't lend you the money. Investors wouldn't give you the hundreds of millions it takes, or whatever the CapEx is, to build the mine if it was unlikely to succeed. And if you do succeed, the re-rate is much bigger than we thought, on the order of a double, as I'm saying. Now, there's a lot we can talk about in there: bear markets, bull markets, different metals, and so on. But this is the pre-production sweet spot. What my contribution to the field is that the re-rate is actually much bigger than anybody had anticipated before. And for some strange reason, even though I've now published this more than 3 years ago, my initial findings, the market's still not pricing this in. You can still make money in the pre-production sweet spot. We could talk about maybe why, or any one of these issues we can talk about for more, but that's the idea, is there's a fairly reliable way to find really exceptional gains in the resource sector, the pre-production sweet spot.
Yeah, and it's certainly not like you need any confirmation, although I did find this interesting quote. It was the legendary resource investor Rick Rule who recently told me that my pre-production sweet spot work may be the most important thing I've done in my investing career. And after failing to find any flaw in my thesis, he too adjusted his course to speculate accordingly. So again, we're not just talking about something theoretical, but that people are using and having success with. And curious, I actually just mentioned a minute ago the why this happens. Is it just that one of those areas where other people haven't put numbers on it before and we gloss over it? Or why do you think the effect is so pronounced?
Well, my ego may have a hard time with this, but I'm not as famous as Doug or Rick or any of these other guys. Maybe it's still just not that well known, or people are still skeptical, or perhaps it is known, but we really haven't had a roaring bull market to bring a lot of people in to put this into practice. And even though the pre-production sweet spot still can deliver gains in a bear market, they're not as great, obviously. And if people were concerned about the prices of metals, maybe there just hasn't been a chance for a lot of people to put this into practice. Time will tell on that. What I can tell you is that since becoming the independent speculator, I have tried this. I have some pre-production sweet spot picks in my portfolio now. I have a couple that have completed. And if you go to independentspeculator.com and you go to the bottom of any of our pages, or there's a nav bar at the top, you can click on the track record, and you can look in the track record, and there are several pre-production sweet spot closed trades. So you can see that I'm implementing this, I'm working on it, and I've had some good wins already. No, spectacular through the roof wins yet, but maybe now with gold breaking out the way it is, maybe those are what's coming next. But I am still working on this, and you can see on my track record that I'm implementing it, that it's still working. I have two of them have delivered a solid 50% gain, more or less. And one of them got taken over. So who knows? It might have gotten higher by the time that it completed the mine. It was cut off. Cash offer. What can you do? Right? You're out. You're done. The other one, I'll go ahead and mention. It's Lundin Gold, which recently reached first pour on the Fruta del Norte gold mine in Ecuador, which is a huge world-class gold mine. And so, as per the formula, the beauty of the sweet spot is that it gives you a very clear entrance and exit point. You know exactly when to get in and get out. There's no vagueness about it, and it's fairly reliable. It's predictable profits. How great can that be in the world of speculation? Yep. Right? But you have to follow the formula. So I did. I exited last November on my 50% gain. Not huge, but decent money. If I put $1 million in, that'd be $500,000. Who can complain? And the freaking stock has kept going up and up since then. Gold prices haven't hurt. So if I had held to now, as you and I speak, I would have more than 100% gain. And I'm getting off the topic of why does it still work. We've had a couple theories, but let me just follow this thought through to its logical conclusion. And this is something new that my latest research, if you've heard of the pre-production sweet spot or read what I've written about it before, back in my Casey days, they called it the golden runway. For the marketing guys wanted something more interesting than pre-production sweet spot. So we called it the golden runway. I was complicit in that, I admit. But anyway, so if you read my previous golden runway work, one of the conclusions was this clear exit point, right? That you wanted to get out at first pour. You might make some more money if you held on through the commissioning phase and all the ins and outs of the plant to commercial production, but that actually added a long time to the pre-production sweet spot, and the additional gains weren't much, and in some cases they were losses. The mine didn't actually work as planned. So there was extra risk if you held on. So we always thought of the exit point as being first pour. That's what I did with Lundin Gold last November, and I booked my 50% gain. My most recent research, this is a new finding, shows that actually on average the gains are significantly higher if you hold on past first pour to the announcement of commercial production. And this Lundin Gold is a case in point. I could have doubled my gains over my exit point, at least as of now. We'll see what happens to the stock by the end of commercial production. What happens? This is ongoing, but it's really striking that as you and I are speaking, we have a very clear case in point of exactly what my latest research shows might be the case. So I'm not quite ready to entirely shift my practice because there is risk after first pour. Sometimes mines don't work the way they're intended to. But it gives me a little bit more flexibility on the exit point. So if the stock is really doing well and there's no reason for alarm, I probably would not now exit at first pour, but hold on to see what happens by the time we get to commercial production.
Yeah, that's interesting. You mentioned that. And one of the things I was thinking as you were saying that, let's say there's a project that you like, but it's outside of that sweet spot. Would that possibly influence you to hold off, or how do you treat something where maybe all of your other indicators would say, yeah, here's a go I would normally buy, but if it's outside of that sweet spot, how does that factor in?
Well, you could be outside of the sweet spot before and after. So there's two ways that could go. And the data all along has shown, obviously, if you could get in early, before a company gets into the pre-production sweet spot, it's not a surprise to anybody, I think, if I'd say, well, that would increase your gains. The problem is that until you enter the pre-production sweet spot, there's a great deal more risk, right? Some 95% of the companies that start building their mines complete it. That's huge. But how many companies that have a deposit actually even start building? Not so many. It's certainly not 95%. It's maybe 1 in 100, I don't know. A lot of companies make discoveries and they never become mines. So by going for the production spot, yes, you can increase your gains, but you also take on a lot more risk. And it may sound like I'm patting myself on the back here, but this actually is something where I can help. This is something where I have 15 years plus now in the field, and I have a pretty good feel for what makes for a good mine. And I actually have a pre-production sweet spot pick in my portfolio now. That's one that it's obviously going to be a mine. They're not officially in the pre-production sweet spot yet, but they're headed that way. I have no doubt that this will be a successful PPSS play. And why wait? So if I'm that convinced of it, I'll get in early. Otherwise, it is a reason to stay away. If in addition to my main newsletter that we're talking about, the Independent Speculator, I have a more entry-level one called My Take that does not disclose my personal portfolio the way the Independent Speculator does. But it's simply that. It's my take on a bunch of resource companies that people ask about, over 160 of them right now. And if you read through that, you'll see that a lot of those takes will address this question. There'll be companies that, looks like they're headed towards production. It looks like it's interesting. They have a discovery in hand, but they're not in the pre-production sweet spot yet. They're in what we call the boring engineering phase, or some people call it the orphan phase. If you look at those, life of discovery stock charts. So a lot of them were like, yeah, this is great discovery. I have no problem with this at all. But why should I buy now? They're either in, that valley of death of the boring engineering phase, or they're headed into it. Why would I buy then? Why not wait until they de-risk it? They've got the money, they've got permits, they've answered all the technical questions, and they're starting to build the mine. Then my risk is much lower, and according to the pre-production sweet spot research, I can still bag a solid gain. Not as big as getting in early, but much lower risk.
Yep.
And so yeah. On the other end, sometimes people say, "Oh, well, these guys have built this mine. It looks great. Is it a good buy?" It might be. It might not be. It's a completely different question. At that point, it's no longer a PPSS play. If you don't actually know yet whether the company makes money, there is risk. There are a lot of times where companies build a mine, and I'm not just saying some fly-by-night junior, whatever, even the biggest mines. Remember Goldcorp, they spent almost $1 billion building the Éléonore gold mine up in Quebec, first-class, world-scale operation. And it, sorry, my screen just went blank. Can you still see me?
Yep, we still got you here.
Sorry, okay, all right, now you're back. World-class operation up there in Quebec, and guess what? The deposit wasn't what they thought it was when they got underground. It was geometrically much more variable. They thought it was shaped like this. It was more like this. Mine's okay now, but if even those guys can make a mistake on that scale, it's just very high risk until you know. But then when you do know, when the mine has a couple quarters of steady, profitable production, well, then everybody knows, and the value proposition there is much different. So at that point, it's not speculating for a hockey stick. At that point, you're really asking yourself, do I want to own this profitable producer and its growth profile? A very different kind of question. The answer may be yes. A lot of people want, that kind of stuff. That's fine, but it's different from the PPSS.
Yeah, and by the way, for folks watching at home, the link for those services, as well as, I guess I pointed early, but it's all down there in the description. I'm also going to put the link where you can opt in and get your report that you wrote about the sweet spot, as well as the My Take and the other services you offer, because I'm sure there's a couple other folks who are following my quest to be the lazy investor and wonder something you mentioned here. While pre-production sweet spot plays are a safer way to play, you can't just throw darts at the board and expect to make a fortune. You mentioned of PPSS companies that built their mine filled to yield a positive gain, some 5% yielded negligible or minor, and a good 45.7 yielded only modest gains. So obviously, like you were saying, it's one factor that, when combined with other factors and knowing the projects really well, which fortunately you dig into and share for the people who get your research, when you put them all together, you can hedge out some of these risks that you don't have to take on.
Right. So thanks for mentioning that. And for anybody that's curious about this, there's a lot more to it than you and I can get into in this brief interview. But we should say that report, I've written a detailed report outlining my latest research on this, and it is available completely for free. You can go to independentspeculator.com. There should be a big banner at the top with the pre-production sweet spot. There's a link there where you can download this report for free. Obviously, I'm hoping we'll do business in the future. I'm hoping to persuade you to hire me, to put me to work on your behalf, helping you make the best picks here. But no arm twisting, no hard feelings. The report is available for free. Now, to address the point you just made, this is also perhaps a little job security for me. It's important to be very clear here. 95% of the companies that start building a mine succeed at building that mine, especially if you include the takeovers that then go on to build the mine. That doesn't mean 95% of them are profitable. Sometimes in a bear market, you do lose money. And even if you do have some profit, like if it's a 5% gain from construction decision to first pour or commercial production, but that took 3 years, that's not a great gain. It's better than losing money, but you could have done better with something else. You could have done better leaving the money in the bank with high performing bond or something, perhaps. So if you subtract those out,
existed.
if those still existed, yeah. But it's important to be clear here because I don't want anybody to walk away thinking, oh, 95% chance I'll double my money. No, it's a 95% chance that the mine will be built. And the average, and some of those are really high. Some of these from construction decision to first pour, some of these things are like 6, 7, 8, 900% gains, which is fantastic, right? On the order of a discovery, some of these. But having those big wins also means on the other end of the spectrum, there are minor wins or not wins at all and losses and so on. So 95% build the mine, but only 70% of the cases plus returned any positive gain at all. And some of those are so negligible, it's really about 50-50 whether you're going to have a significant win or not. Now, compared to, buying some resource junior that has nothing and hoping they make a discovery to get your 10-bagger, 50-50 odds aren't bad at all. Right? That's not a bad thing. But I don't want anybody to walk away thinking, oh, PPSS, this is a sure thing on doubling my money. No, it's not. But I think I can help you with that to improve your odds.
Yeah, well, I appreciate you phrasing it like that because, again, especially in the mining world, we're looking at probabilities. Sometimes they find something, sometimes they don't. But when you combine all of these and have a good underlying knowledge of the companies you're looking at, can certainly skew those numbers in your favor. So I really appreciate you sharing all this. I've been excited learning about it. And perhaps just in wrapping up, you can let folks know again where they can find you and some of the things you offer, and if they want some help really having expertise on these names.
Sure. Well, thank you again for the opportunity. It's pretty simple. Just go to independentspeculator.com. I am the independent speculator. I declared my independence from Casey Research, but in homage to my former mentor, Doug Casey. I actually asked him before I did this. My independent speculator is clearly very similar to the international speculator I used to write for Doug. But I asked him about that. He was okay. He gave me his blessing. So I am the independent speculator, and you can find out all about the stuff at independentspeculator.com. Right at the top, you should be able to find the download for this pre-production sweet spot free report. You can also click on various things to find our services. There's descriptions of the main newsletter, the Independent Speculator, where I disclose where I'm putting my own money, my own hard-earned money. That's the core value of that service. I also put out alerts and things to let people know what's going on. And then there's the entry-level My Take service, which is really, it's evolved a little bit. It was meant to be, interesting companies, what's making news, my take on the latest big merger or something. But I take requests, and now it's really become all about the requests. People want to know about all these different companies that they're worried about or they're interested in. And in many cases, I've been there with management. I've been on the property, or I know the people involved, or I know the people who had the project before. So I can add value there. And these are available on a monthly or yearly options. All this information is there. Bottom line, if you have any trouble or any confusion, you can write to me. Just write to the letter L at independentspeculator.com. My business is still small enough that I can answer reader emails, and I do. So I will do my best to help you out.
Well, I appreciate that, Lewis. You do a great job knowing these names. Sometimes I'm stunned at a lot of the analysts like you, how many different names you know in such detail. So all that information is in that description below. By the way, I can see Doug Casey looking over your shoulder from the bookshelf there, right on the money. So I know you do have his blessing. You were trained well. And again, I appreciate you sharing this and look forward to catching up again soon.
Thank you, Chris.
So that is today's episode. I do thank you for spending some time with me and hope you enjoyed it. If so, go ahead and hit that subscribe button, and I'll see you again soon.